America's Mortgage Choice. I wanted to just give a quick follow-up on the discussion we were having last week regarding the purchase that you're looking at in today's market. I know we've seen a big change in mortgage rates over the course of the last couple of weeks. I wanted to take a little bit of a longer view to put that in some sort of context. What we've seen over the course of the last few months, really from March on, is that rates got into that 5% area, and these are kind of weekly grids with daily grids, and you see that the green means rates are getting better and the red means rates are getting worse. What we saw up until the middle part of May was a fairly steady as she goes, rates hanging around 5% area. So we had people saying, well, I want to get 4 3/4, or I want to get 4.5 with 1.5 points, or whatever it looks and feels like. But we really had a reversal in the market, and a couple of things have combined to do that. As you see, it's been primarily negative over the last couple of weeks. So the trend has really changed and created a situation where rates are, if you will, vibing negative, and we just don't think that we see a big improvement in the future. And that's because gas prices have shot up, oil prices have shot up, and there's been news that although there's still plenty of unemployment out there, that the economy is starting to bottom out and looking towards recovery. Additionally, the market has become concerned with all the spending that's gone down relative to the bailout and some other things. So as you can see, this trend is not good. What we have here is a 30-day moving average, and I'm going to select that just to be sure. The 30-day moving average shows that rates are right about average, which means I don't expect a big snap back here over this line. I just don't see that in the cards. The trends here show us that it's just not going to change for the better dramatically. Doesn't mean it won't improve a little, maybe get back into this range, but the idea of getting 5 or 4 7/8 is probably out of the cards. And the reason I wanted to bring that up is I know we were talking about the purchase of your property, and you've got this deal at $300,000, and given the amount of real estate owned by the banks and the foreclosure sales and all the other stuff in the market, your seller is willing to sell at $300,000 today because there's still a lot of stress out there and it's the bottom of the market. A couple of weeks ago, I know we were talking, that was at 4 7/8, or you could pay 1.5 points and by putting 20% down, get 4.5. Those are kind of off the table now. If your seller's still willing to accept $300,000, I would absolutely take it. I think we could float the rate possibly and do better, but today you'd be at 5 3/4. It is a pretty dramatic increase in terms of $1,401 versus $1,270. It's $130 a month. My concern is the following, that if we do see some market recovery and we do see any sort of pickup in jobs, housing, interest rates, etc., that even if we do get a little bit better interest rates, 5 1/4 perhaps, but your seller decides they can get $330,000 for this house and gets away from $300,000, you're going to be at $264,000 in loan at 20% down. If you still bought that place at that point, it'd be $1,458 a month. It'd actually be more expensive at a higher price, even if you got a lower rate. One of the things I always tell clients is, you've heard the cliche of don't let the tail wag the dog. The dog is the house. Don't let not getting a great deal on a mortgage prevent you from getting a really great deal on a house. There's always opportunities to either float the market, consider paying points, or refinance later if rates drop again. But if your seller thinks it's no longer the bottom of the market and it won't sell from a position of distress, you could end up paying more monthly in the long run rather than less. If you have any questions about this, let me know. I can always be reached at 630-368-3300 or